that as we get going. I have started recording this so that others who do not have a chance to join today can view the recording later. And I invite you to jump in with questions either on the chat, as I said, or unmute yourself and ask them that way. That's fine too. Without further ado, why don't we dive in? But I will keep an eye on the chat for anything you put in there about the particular industry that you're in or particular areas of interest that you have for questions. And thank you in advance for doing that. Okay. Just to reiterate, I don't mind interruptions. I love questions. So if you have a question, somebody else probably does as well. So don't be bashful. Today, we're talking about the financials of your business and what they can tell you as the owner of the business and what they tell others who might be looking at your business from the outside, for example, lenders. Financial terminology is often considered, in effect, the language of business because so many people talk about their business's finances either directly or indirectly at some point. And your financials are important because, well, financial issues can arise in both good times and challenging times. They are not restricted to being issues that arise only in bad times. Strong growth can also lead to financial issues arising in companies. And so it's important that you keep an eye on the future to anticipate them so that you can address them sooner rather than later. Your financials can also help you manage your business better. And some of the ratios we talk about later will give you a sense of the way in which you can do that. We won't be discussing an absolutely complete list of all possible ratios you could look at, but we're going to talk about the ones that are generally useful in many businesses, and we can talk about further ones later, depending on your particular circumstances, if you wish. If you're not already comfortable reading your financial statements, this is my pitch to you to try and develop that comfort, because it is a very useful skill for anybody who is running their own business. And I fully recognize that many people may be new to looking at financial statements, and that's fine. It's something that I think is a little bit of an acquired taste. The more you look at them, the more you think about your financials, the easier it gets to figure out what they're telling you. So don't feel you should have mastered the whole thing at once. Instead, start with some areas that you feel are understandable and start monitoring them. And then over time, expand the numbers that you look at in there. And in time, you'll find that you need very little outside assistance or advice, and you'll feel comfortable consuming most of the numbers that your financials report to you. So, as I mentioned, we're going to look at your financials from two common perspectives, from the perspective of management of the business and from the perspective of a lender. And I'll show you some sample data, and we'll talk through the ways in which, for example, a lender might analyze it. Let's start with the management perspective. As a manager of your business, you're looking at your financials because you want to understand your overall business health. You want to gain a sense of any upcoming financial commitments or needs of the business so that you can anticipate them and act before it's a crisis. And look for some possible operational improvements. Are there things that your financials show you that might indicate ways in which you can improve the management of your business? And along the way, I would hope you're also going to gain a good understanding of potential risks to your business that might have been identified from within your financials. So those are all things that come out of examining your financials on a fairly regular basis, getting comfortable with them. And once you're comfortable with them, I think you'll find that when you look at them, stuff that's odd will pop out a lot more quickly. But if you haven't been looking at them regularly, it won't necessarily pop out. It'll take some more work to uncover stuff that's unusual or different. So that's a good reason for looking at your financials regularly. So how do you look at your financials? As I mentioned, we'll show you an example in a minute, but the thing we're going to start with in when looking at the example is by comparing the balance in a particular account from this period to, say, the same period last year, or perhaps the last month or last quarter. It's your choice. Different businesses look at different time periods to compare things to. But the first step is often just to compare the current balance to a previous balance. And what's most important is to understand why it has changed. It will almost always change. And so change isn't bad. But if it didn't change in the direction you expected, that's something to look into. Or if it changed by more or less than your intuitive sense of things would have led you to believe, then that is another number to dig into to try to understand why it differed from your expectation. The key items to look at from this perspective, in my view, are on your profit and loss statement, your total revenues, your gross margin, your expenses, and your net profit. They're the big numbers. So how much did your customers pay you? After you subtract cost of goods sold, what was left over? What were your total expenses? Did you keep them under control? And then what's your net profit? What's the bottom line? Is that what you would have expected for this volume of business in this period? The other key area to look at is your balance sheet. What are your cash balances? Is it normal? Is it what you expected once again? How are your accounts receivable? The amounts that are owed to you by your clients, if any. If you offer terms to your clients and they pay in 15 or 30 or 45 days, you need to keep a close eye on your accounts receivable, because a late payment is a late payment, and that's cash you do not have yet in order to help you run your business. And then similarly, accounts payable. If you use your accounting software to help manage your accounts payable, that can be a source of cash to your business by paying accounts only when they're due instead of paying them the second that you receive them. That's okay. But if you are not paying them immediately and you're paying them when they're due, then you need to keep a close eye on what is due and get those checks out the door, and your accounting software can help handle that. But particularly in growing businesses that do receive terms from their vendors, you can use accounts payable to give you perhaps a 2-3 week source of additional cash, which can help fund your growth. So take advantage of accounts payable when you can. So from a management perspective, after looking at the balances and how they might have changed, here are some ratios that you may wish to look at. And in general, when you look at a ratio, you're comparing it to that same ratio for your business in the last period that you looked at. But you might also be comparing it to industry norms. So, for example, the first ratio is gross margin percentage. And this is your gross margin, which is revenues less cost of goods sold, divided by the total revenues for that same period. And so that's telling you how much of those revenues is left over to pay for your overhead costs after you subtract the cost of everything that you just sold.
Oh, okay.
And this is a number that, for example, if you are in a retail business, is commonly around 50%. About 50% of what you get from a customer is going to be available to pay down your overhead expenses. I'm just and so gross margin percentage is a good number to keep an eye on. And in particular, if the nature of your business hasn't changed much, if your gross margin percentage goes down from one month to the next, that tells you that your cost of goods sold is going up. and you need to raise prices in order to stay ahead of inflation. If your gross margin percentage is going up, that's wonderful for your bottom line. Doesn't happen very often in a lot of businesses. So why is that happening? Next item to look at might be inventory turnover. This can be measured by looking at your cost of goods sold divided by your inventory balance. Now, if you're a cash business, you might not maintain an inventory balance. But if you use the accrual method of accounting, you will have an inventory in your books in many cases. And this is something that is a useful measure of how appropriate your level of inventory might be for the pace at which you do business. So if your inventory turns over quickly, that's a good sign. It means you're using the money you put in inventory very efficiently. If it turns over slowly, maybe you have room to tighten up your inventory management and get some cash out of it by not repurchasing inventory quite as quickly. Now, what do I mean by turning over quickly or slowly? Well, that depends entirely on the industry that you're in. And so that's an area where you might look at industry norms to see how your inventory turnover compares to the norm for your industry. So for example, if I'm looking at cost of goods sold for the month and I'm looking at my current inventory balance, if I had a turnover of 1, that means that the cost of goods sold is exactly equal to my inventory, and I have an inventory that's about 1 month of sales. That might be a little too low for a lot of businesses. On the other hand, if my inventory was 1/12, then that might mean that I have enough inventory to last me a year, in which case you might go look at, well, are all components of my inventory turning over equally quickly or slowly in this case? Or do I have some items in inventory that maybe I have too many of them because I don't sell a lot? So all of these things raise questions that usually will need more investigation to come up with a good answer for. Next one is days sales outstanding. This is your total accounts receivable, the amount that's due to you from your customers, divided by your revenues for the same period that you're looking at. Now, if you think about this, if you take the amount that's due to you in total and you divide it by your revenues this month, that accounts receivable balance is probably something that's accumulated not only this month, but some from last month and the month before too, perhaps a bit, depending on how everybody's paying. And so you might find that the accounts receivable is a larger percentage of your revenue. There's a number of people who will pay on time, and so they won't be in accounts receivable. So maybe you find your accounts receivable is, say, 50% of your revenues for this month. If you multiply that by the number of days in the month, you would get something like 15, which means you've got about 15 days of receivables outstanding, which is a great number, particularly if your terms are pay in 30 days. So once again, this is a number to look at, typically compared to industry norms, but also it's good to watch for changes in this number compared to last month. Your current ratio is another measure that bankers may look at often. And it's something which is calculated by taking current assets, which are the assets on your balance sheet, which you could potentially turn into cash within a year's time, and dividing that by current liabilities, which are the liabilities on your balance sheet that you will have to pay within the next year. So the current ratio is a measure of, in effect, how much your current assets exceed your current liabilities. If your current ratio is less than 1, your current assets are not enough to pay your current liabilities. Now, for some issues, for some industries or businesses, that's not an issue. They'll generate that. You've got your busy season coming up or whatever. But most people looking at a balance sheet, if they see a current ratio that's less than 1, that raises a question mark in their thinking, because there's a risk that that business might not have enough assets to pay off the current liabilities. And then lastly, your debt to equity ratio. If you take your total debt from your balance sheet and divide it by your total owner's equity, that's your debt to equity ratio. And once again, this is something that can vary quite a bit from one kind of business to another. But if I see a debt to equity ratio of 1, that means that you owe just as much in debts that must be repaid as you have owner's equity in the business. So if you repaid all your debt tomorrow, your cash might be wiped out. No, that's not necessarily bad. It just means that you haven't necessarily accumulated much value in your business yet. On the other hand, a more typical thing might be debt to equity of a half, in which case you have built up some equity in the business that would not be wiped out by repaying all your debt tomorrow. And that's a healthy sign. So in general, the lower the debt to equity ratio is, the better. But particularly new businesses that relied on debt to start are going to have much higher debt to equity ratios. And that by itself is not bad. It's just something that over time, as the owner, you would hope to work down. So for all of these ratios, the goal is to understand why they have improved or deteriorated since the last time period that you're comparing them to in your business, or compared to industry norms if you've researched those for your industry. From a management perspective, another thing you probably want to do is update a 6-month or more cash flow forecast for your business. And in this forecast, you are going to guess at, and it is a guess, you're going to guess at your expected monthly revenues for the next 6 to 12 months, each month. You can use past history as a starting point and then any changes from last year, but try to make a guess as to what your revenues might be each month. And then your total expenses for those months. That'll probably be easier to forecast. And then think about, do you expect your inventory levels to rise or fall? What do you expect to happen to accounts receivable and accounts payable? If accounts receivable goes up, that will tend to reduce the amount of cash you have on hand. If accounts payable goes down, that will also reduce the amount of cash you have on hand because you used it to pay bills. If your inventory goes up, you've invested money in inventory, which will hurt your bank balance. So you're always trading off between, would I rather have the inventory to sell if somebody walks through the door, or would I rather have money in the bank and risk maybe being low on inventory? Something else to watch out for, which has a huge impact on your cash flow, is capital expenditures. If you buy a new piece of equipment, that will consume your cash unless you use a loan to purchase it. And yet it won't necessarily appear on your income statement in full. If I buy a new vehicle, I may be out $40,000 for that vehicle, but I will not see a $40,000 expense on my income statement, because usually I'm going to capitalize that expense and then depreciate it over the life of the vehicle. So I'm only going to see a portion of that appear on my income statement, but all that cash might have left my bank account. So look carefully at capital expenditures. And in the same vein, when you make loan payments, if you have outstanding loans, each loan payment really has 2 parts to it. One part is interest, which is an expense on your income statement. But the other part of your payment is a principal repayment. And that principal repayment is not an expense on your income statement, but it does reduce the cash in your bank account. So it's important to think about your capital expenditures and your loan payments going out every month for the next 6 to 12 months. And then look at what that predicts for your bank balance at the end of each month. And don't forget, if you're drawing money out of your business to pay your living expenses, those are owner draws. Those should also be factored into your cash flow forecast. Once you have all of those biggish things that tend to be the bigger items that affect most people's cash balances, look at your projected cash balance for the next 6 to 12 months. And if it ever gets too low, whatever that means to your business, well, now you have time to try to address that. Maybe you'll postpone some purchases. Maybe you'll go to the bank and get a line of credit to draw upon when you need it. But that helps you survive low cash times in your business. So that's all I had to say from an owner's perspective. Compare balances, look at some key ratios, and develop your understanding of your own financials over time so that when you see something that is different than you recall or that sort of violates your gut feel, you know to look into it to try to understand why did that happen. From a lender's perspective, if you either have an existing loan from a lender or are going to go and apply for a loan, here are the things that a lender is typically going to be looking for in your financial statements. Now, if you already have a loan, there are covenants to that loan. There are requirements that you agreed to when you accepted that loan. So a lender's first goal is to look at whether those covenants are being adhered to or not. If you are applying for a loan, they're going to say, well, do your financials meet the typical covenants that they insist upon in every loan? And if not, they're going to talk to you about that and see if there are ways that you could meet those covenants. We'll talk about what those might be in a minute. The other goal of a lender is to understand your business. And looking at your financials helps them understand many elements of your business, maybe not all of it, but it's often a good starting point. And they may have some questions that come from your financials that they'll ask, not because they're criticizing your financials, but because they just want to understand your business better. Their goal is really to help you succeed, because if you succeed, then you'll repay your loan, which helps them succeed. So a lender is not your enemy. They can be a really good friend, and treat them that way. A lender also wants to look at any changes since last quarter or last month or last year, whatever time period they're comparing to. And in fact, if you're applying for a loan, they will often ask for several years of financials so that they can see your history and see what has changed. And their goal in all of this is to reduce the risk of their not being repaid, while at the same time being helpful to your business. So look at a lender as a potential partner in your business. Yes, legally they're not a partner. They hold debt that you have to repay, but their goal is to get it repaid, and their best way of getting repaid is to help your business succeed. And they may have very helpful advice for you. So from a lender's perspective, probably the most common thing I've seen talked about is the coverage ratio. The coverage ratio is your earnings before interest, taxes, depreciation, and amortization. So it's your bottom line before you make any loan payments or pay any taxes or take out depreciation. Why did they look at that number? Because that number represents the cash that your business has available to do things like make debt payments or pay taxes. And they then divide that number by the total required loan payments in the next period. So for example, if I'm looking at financials for 12 months, I would look at the required loan payments over the following 12 months or over the same 12 months that are being reported upon. Most banks for for-profit businesses are going to want to see a coverage ratio, what I've heard of 1.3 or better. For nonprofits, they might shrink that down to 1.2 or better. What does that mean? That means that you've got 20% or 30% more cash available than is needed to make the required loan payments. And those loan payments are interest and principal. So they want to see you having more cash than needed to make the required debt payments. And why 20 to 30%? Well, because that's probably about what you're going to need to pay taxes. So that's a really important ratio for you to look at relative to any debt you have outstanding. Then next, the lender is going to want to understand and monitor the operations of your company. And this perspective is not going to be very different from yours as the manager of the company. Is your revenue rising, steady, or falling? If so, how fast? It's not to say good or bad that it's rising or falling, but understanding how it's changing and whether that's normal or not is important. What's your gross margin percentage? What's your gross margin as a percent of revenues? Are your variable expenses changing over time or staying steady? If they're changing, why? Also, in the same way, look at your net income as a percentage of revenue. What percentage of your revenue turns out to be profit after fixed expenses? If that number is going down, maybe your fixed expenses are rising faster than you're increasing your prices. If it's going up, maybe you're controlling your fixed expenses really well as your revenues are growing. So this, once again, is a number which by itself is neither good nor bad, but it invites questions that helps people better understand the operation of your business. Looking at accounts receivable as a percentage of revenue is also very important. If it is growing as a percentage of revenue, you are collecting less cash from every dollar of sales than you used to be. That's often a problem. It means that maybe you're not staying on top of your accounts receivable as much as you should be. If it's staying steady, okay, that's steady. If it's shrinking, pat yourself on the back. You're managing your accounts receivable well. And then inventory. You could look at inventory as a percentage of revenues if you wanted to. You could just look at it as an absolute dollar value if you wish to. But if inventory is growing, the important question is it growing in proportion to your business and to meet valid business needs? Or is it growing because you're not managing it as tightly as perhaps you should be? That would be a question that a lender would be asking themselves. So let's look at some sample statements here and go through some of these. Here is a sample income statement, and the arrows are pointing to the accounts that I'd mentioned earlier in this presentation. So if we look at sales, as you can see for this company, there are two sales columns, one for 2020 and one for 2021, and each represents the full 12 months of sales for this business. You can look at the two columns on the right and see that sales went up by 7.6% from last year, from the previous year to last year, which is great. So they went up by a total of $18,000 and change. So, okay, I'm in a business that's growing. Well, is 7.6% about what the inflation in food costs were? In which case, yes, my revenues are growing on a dollar basis, but maybe I really haven't sold many more units than I sold the year before if my prices are rising with inflation. Next, you have cost of goods. They only increased by 3%, so that's good. That means that my rise in sales was not just due to inflation in cost of goods. and my gross margin has increased by 12%. So I've managed to increase my gross margin from 2020 to 2021. That is always a good thing. Is it sustainable becomes a question. But for the moment, that would be a very positive sign. If you look down below the gross margin line, you can see the gross margin percentage increased from 48.3% to 50.5%. So I've managed to increase my profitability. Maybe it was too low the year before, and I made some pricing changes to get it more in line with what I wanted to have. And these financial statements would say that maybe I succeeded in doing that. Down below, looking at total expenses, they have grown by 0.4% over the year. And these other expenses down here tend to be more fixed expenses, things that don't necessarily vary very much with the volume of sales I might have in a year. So it would make sense that even though my cost of goods sold grew by 3%, my total expenses only grew by 0.4% because I was controlling my overhead expenses well. The net result is my net operating income. This is before depreciation, and it grew by 161%. Whoa, that's awesome. To have my operating income grow that much is great, particularly when my sales only grew by 7.6%. How can I have that dramatic a change in operating income when my sales only grew a little bit? Well, the answer is I controlled my cost of goods sold and I controlled my fixed costs. And so almost all of the increase in sales flowed through to operating income. If you can do that, that's great. Then I subtract depreciation, which is of items I bought in previous years, which I'm gradually depreciating as I use up their value, so to speak, to my business. And I end up with the net income that I might be taxed upon. And that also grew quite nicely during the year. So these are some of the items I might look at on my income statement. And I've tried to talk you through how I might think about them. On the balance sheet, the items I mentioned were, look at your cash on hand. In this case, it shrank by $1,000 from the previous year to this year, or 25%. That's potentially alarming to have cash shrink by 25%, but $1,000 isn't necessarily a huge number in the context of this business, so that by itself doesn't raise a concern for me. My checking account, it's another form of cash on hand. It grew by $1,400. Oh, well, if I put the two together, my total cash grew by about $400, so I'm okay. My accounts receivable shrank by 0.4%, $241 less, not much of a change. Well, if my sales that we were talking about earlier grew and my accounts receivable shrank, that's good. Skip down to accounts payable, and my accounts payable grew by 25%. So providing that I'm not getting hit with late fees, et cetera, I'm paying on time, that's an indication that maybe I'm taking the credit that my vendors offered me and I'm using it more to my advantage to maintain perhaps a slightly larger inventory. Well, if I go back up top and look at the inventory, you can see, oh yeah, my inventory line has grown by 39%. So it looks like my vendors are financing much of that growth in my inventory. So I hope by the narrative I've spun for you in looking at these numbers, you can see how something I notice about a change from the previous year to the last year can lead to some interesting questions and can then lead to some insights about how the business has been operated. This works just as well for you as the business owner as it does for a lender as they look at your financials. Now to look at some of the ratios. The gross margin percentage gross margin divided by revenues, has grown from 48 to 50%. That's good. It means I have more money available to cover my fixed expenses. My inventory turnover shrank from 1.7 to 1.2. That is a sign that perhaps I'm carrying too much inventory now relative to the volume of sales that I have. So maybe I've put too much in inventory. That's a judgment question. Maybe you put it in inventory because you're running out of some things too often, and now you're not, in which case that's good. And maybe that's helping support your higher volume of sales. So a lower inventory turnover by itself is not necessarily bad. It's just a potential warning flag for something to look into. Your days sales outstanding shrank from 87.6 to 81. So that's the indication of you're doing collecting your accounts receivable. Yes, do you have a question? No, guess not. Your current ratio, that's current assets divided by current liabilities, has grown from 2.9 to 3. So that's good. That means that you should have plenty of working capital to help operate your business. Your debt to equity ratio has shrunk from 0.4 to 0.3. That's also good. That means that the amount of debt you have in the business relative to the amount of equity in the business has reduced, and therefore you as the owner have a greater proportion of equity in the business. Your coverage ratio grew from 1.6, which was fine, to 3.8, which is great. Well, any lender seeing this is going to be very happy because the chances of the required payments not being able to be made is way down. Your net income as a percentage of revenues, in other words, your profit as a percent of revenues, grew from a little under 3% to a little over 8%. Much healthier profit ratio. And your accounts receivable as a percent of revenues dropped from 24% to 22%. So it looks like either fewer clients are obtaining credit, or those that do, you're managing it better. So that's how I look at the ratios for a given business. From the lender's perspective, cash is king. So you want to pay careful attention to your cash balance versus last year. Is there a trend? And you also want to look carefully at working capital. That's current assets minus current liabilities. You want to make sure that it's not getting worse in a significant way relative to the changes in business volume that the business is experiencing. If you have too little cash, whatever that means in the context of your business, that can prevent your business from operating freely. Maybe you don't have the cash to reorder inventory as soon as you'd like. Too little cash can prevent you from making debt payments, and you can get in trouble with those that you owe money to. And too little cash can prevent you from growing your business the way you might like to. So that's why looking at a cash forecast is really important for your business. But from a lender's perspective, they're going to watch your cash balances very closely, because your cash balance reflects in part your ability to meet your obligations for the debt that you owe to them. So they're going to look very closely at anything that has to do with your cash balances. That's most of what I have to get through. We have plenty of time left over for questions. Hopefully I've raised some issues for you. What questions would you like to discuss? Are there things you want me to dive into in more detail? Or do you have additional things I didn't talk about that you would like me to try to opine on? You're welcome to unmute yourself and jump in, or put questions in the chat as you wish. Are there certain ratios that didn't make sense? I see one in the chat here. Oh, good. So about how to generate statements. Okay, I'll scroll back up to the beginning. And a solo law practice would like recommendations for generating statements. Okay, so in a solo law practice, chances are you need to bill your clients, obviously. So I would imagine for your own sanity, you may be using some software to help track your time and then generate invoices for your clients. That software may not be a full accounting package, but hopefully it might be able to be. That should certainly be able to generate information on your revenues for you. But if it's really just an invoicing package, you may need to transfer that revenue information into either a spreadsheet or an accounting package that you use to track your books. There are many options for accounting packages for small businesses. Some are free, some cost big bucks. I generally refer people to the PC Magazine annual review of accounting software for small businesses. That gives a good, relatively unbiased review of many of the options that are out there. And in the past couple of years, last time I looked at it, it includes QuickBooks, which is the 10-ton gorilla that everybody's probably heard of. But when you went and looked at its pricing, you may not be willing to pay its cost. There are other ones out there like Wave, which can be free for certain levels of usage or certain types of usage. And there are many other alternatives that I think are well compared in the PC Magazine review. So if your billing software, Aaron, does not do accounting for you also, then you probably will need some separate package to help you track the expenses. It doesn't have to be a package. You can do it all in a spreadsheet. But as your business grows, you may find that a spreadsheet doesn't quite do everything you want. A lot of people I know started on a spreadsheet though. So you could have one column for each month and put your revenues at the top, put your expenses for the month down below, and at the bottom, calculating net profit. And then on the far right, you add up the 12 months and get your numbers for the year. Next year, you make a copy of that spreadsheet, delete all the numbers from last year, and then start filling in this year's numbers. It doesn't have to get any more complicated than that. In a law business, you probably don't have a lot of assets, so there may not be a huge emphasis on your balance sheet. But if you needed a loan or something to get started, then maybe you should track your assets as well. Hopefully that addresses your question, and you can go from there. Let's see, what are the other questions that came up here? What's a good low-cost bookkeeping program? Jessica recommends Xero, spelled with an X at the beginning. It's like QuickBooks, but not fancy. I don't know anything about the package. The things to look for will vary a great deal from one kind of business to the next. For example, I was a math tutor for many years. And so I wanted a software that would let me track my time by project and then turn that into an invoice really quickly, similar to what might be needed in a legal business. For other businesses, they might not need that time tracking at all. I didn't have a lot of assets in that business, so I didn't need something that tracked inventory for me. If you're in some sort of a retail business where you're selling from inventory as opposed to selling a service, you probably will want something that helps you do a good job of tracking inventory. What's turning over quickly? What's turning over slowly? What should I maybe stock up on? What should I reduce my inventory of? And having that inventory tracking capability might be very important for some businesses and useless to other businesses. So I mentioned that just as an example of a couple of features which could be critical to some businesses, but not very useful to others. And so keep in mind which features you are really hoping to automate versus may not need to automate yet. And the less you need to automate, typically, the less expensive the package you use is going to be. Jamie asks, for financial projections, what's the best way to determine the markup for a new business? Well, there are lots of ways of doing that. One way is to, to pluck a number out of the air, but that's not what I'd recommend. If you are in an industry where you can find industry ratios, then by all means, use some of the resources available, such as the Portland Public Library has a number of online databases that you can use to dig up a number of industry standards. You may also have an accountant or a banker who has access to typical industry benchmarks that might apply to your industry. Or if you're a member of a trade group for your industry, they may have publications that you as a member are entitled to receive, which can help you dig up typical ratios. In your first year, you might not succeed in having ratios which are as good as an established business, but certainly your gross margin percentage should not be any less than industry standard ratios. Where you may run into trouble in your first year is your fixed costs as a percentage of your revenues. But that's
if I could just interject,
yes,
in regard to this question, we've got 2 more financial webinars that are part of this series. The next one, which will be offered in October, is going to cover pricing, which relates to this markup question. So I think there'll be some good information there.
Yes, thank you. Another question from Deb. What is a common thing that a new business fails to track financially? The most common mistakes that I see in forecasts are revenues. People are often off in their revenue forecast. And it can be they're too high or it can be they're too low. And either way can be equally serious. And then on the expense side, the greatest risk is usually something that's omitted that might be significant for your business. So for example, some people forget completely about the need for insurance. And then all of a sudden they say, I need insurance. And it ends up costing something significant for their business. So when you're doing your forecast, that is something you can get around by looking at other people's forecasts or looking at sample business plans. Once again, the Portland Public Library has access to a database of sample business plans, and you could look at their projected financials to see what kinds of expenses they're tracking. So that's in projecting. If you're looking at history and you're saying, what are you failing to track financially looking back at your past? That is a fairly common occurrence in businesses which have accounts that are too broad. So, for example, if I look at the expense accounts for a business and I see, just looking at the numbers, I see $100,000, and then I see $1,000, $2,000, $500, $50. Whoa, that $100,000 account could probably be broken down. And that $50 account could probably be combined with some others. My goal in looking at expenses is to see the major expenses broken out in some degree of detail, and the minor expenses not cluttering my income statement too much. Now, do not create an account called miscellaneous. That is bad practice because too much stuff is going to get dumped in there when somebody couldn't be bothered to look for the right account to put it in. But it's fine to have an account called supplies if the total for that account does not get too large. If it starts getting big because you're spending a ton on paper clips, okay, maybe you should have a separate account for paper clips. But for most companies, payroll is a big number. And maybe for some companies, you want to break that down. Say if you're in a restaurant business, you want to break that in front of house payroll and back of house payroll, just to help you track that better. So look at your big expense categories and ask yourself whether going forward, I might want to subdivide them somehow into a couple of categories that helps me better understand where I'm spending my money as a business. And for the small stuff, for the $5 and $10 for the year expenses, look at consolidating that. There's no point in tracking those individually when they're really, really small percentage of your total expenses for the year. So mostly, if you are entering all your expenses into your accounting software, you're not failing to track them. But the way in which you're tracking them may not be helping you analyze the operations of your business sufficiently for your needs. And that's where my comments were coming from. If you're not entering all your expenses into your accounting software, then you are missing things. You should be entering every check you write, every amount of cash that leaves things, every credit card expense for your business. All of those, every one of them should be entered into your financial system, and they should all be tracked as part of your business expenses. And if you're doing that, you're not going to fail to miss anything, and that's good. Kendra asks, where can we find the recording to share? Everybody who registered will receive an email with a link to the recording. Today's Thursday. You may not receive it until early next week, but by early next week, you should receive an email with a copy of the slide deck and a link to the recording. Jamie asks, what's the best way to pay the owner with consideration of the financial plan? I'm not certain that I'm interpreting your question as you intended it, but I'll try. If you have a financial plan, which presumably is the financial plan for the business, then you, if you're like most owners, are going to face a natural conflict between your need to pay the mortgage personally for the house that you live in and what the business needs to continue with its plan. If it's growing, it typically needs cash. And that cash typically comes from the investors or the owners of the business. In some cases, it may also come from loans if you have assets that a lender is willing to lend against. If you're a brand new business, getting loans can be difficult unless they are against assets that the bank will take as collateral. If you've been in business for a year or two, then, well, two is better than one, then a bank is going to look at your business history and may be much more willing to lend you money for business needs, looking at the history that you've established so far, even though you may not have as much collateral as a business. They will probably ask you to personally guarantee such a loan, however. In other words, you may use any equity you have in your house to guarantee the loan to your business. So in general, when you're looking at paying yourself, I would look at your cash flow forecast for the business over the next 6 months or more. And if your business has plenty of cash to meet its needs, then you can consider taking some money out as an owner's draw. But if taking that money out would reduce your business bank balance in any of the next 6 months to a level that you consider too low for you to sleep well at night, then maybe you want to consider postponing that owner's draw for the health of your business. It's a tough decision. And if you want somebody to talk it over with and you don't already have a SCORE mentor, sign up for a SCORE mentor. We're happy to discuss quandaries like that with our clients, no charge for our mentoring services. I hope that addresses your question. Deb asks, do you track the percentage that you lose when people use credit cards or cash apps, etc.? Yes, I would definitely track that separately. I would record revenue as the total amount of the purchase, and then you could have credit card charges as a cost of goods sold that reduces the amount of that revenue. And that lets you track how much you paid in credit card charges every year, and it lets you track it as a percentage of revenue as well. That is an incredibly important number to track in this day and age because it's not getting smaller. And the more you can do as a business to manage that, or maybe you're not trying to manage it, but you need to set your prices knowing that you're going to lose a certain percentage of that price to transaction fees from people who pay using electronic payment methods. So yes, that is an incredibly important number to track. We've got about 3 minutes left. Any further questions that I can address? I have a couple more informational slides just about SCORE to finish off with, but I'm happy to answer any further questions. Well, I'll share my screen again here. If you wish to sign up for a SCORE mentor, our services are free. In the slide deck you get, you can click on one of these links for Maine, or if you're not in Maine, you can go to score.org and click on Find a Mentor, type in your zip code, and they will connect you with a mentor. You will receive an email survey, and please do respond to that. We take great interest in your survey comments, so thank you for responding in advance to the survey. And if you don't know much about SCORE, we were founded in 1964. We offer free mentoring and many free workshops. We are a nonprofit. We're a partner of the Small Business Administration, and we have about 320 offices throughout the United States. So we try to meet needs wherever they might exist around the country. And we have a whole bunch of mentors that love working with clients to help address your needs and questions. One more comment here. Jessica jumped in saying, I see a lot of owners failing to include their investments into the company books. Good point. If you put money into your company, you should see that reflected in the owner's equity section of your balance sheet. And if that is not there, you want to make sure it is there, because that's an important part to tracking, in part, whether withdrawals from your company are taxable or not, whether it's money that's pre-tax or post-tax that you put in your company.
Whit, if I could just add in, my apologies if I'm repeating anything that was at the beginning, but I just want to thank our two chamber sponsors, the LA Metro Chamber and the Kennebec Valley Chamber of Commerce. They've helped promote this, and we've sat down with their leadership to try to identify webinars that would be helpful to their members. So thank you to those two chambers.
And Chauncey asked how many parts to the series. There are 3 parts to the series. So those are all visible on the SCORE Central Maine website, probably on all the SCORE Maine websites as well. So the appointed hour is at hand. Thank you all for attending. If you need to go, you're welcome to go. If you have further questions, I'm happy to stick around and answer a few more questions. That's up to you. Have a wonderful afternoon, and thank you very much for joining us today. Thank you, Deb.
Great job, Whit. Thank you.
Any day, Bill. Yeah, I didn't know if you wanted to start it or not. I didn't see you, so I
Well, my problem was that I didn't have the links.